afternoon, folks. It's Dave Burrows. I am CIO and chairman here at Barometer Capital Management. I want to thank everybody for jumping on today. It's Tuesday afternoon. I apologize. I was away last week with my family, but keeping track of things on the screen. Lots going on. It's the middle of summer, but markets are trading and things are happening. And as usual, what we'd like to do is start from the top and kind of take a look at what's going on from a big picture perspective. I've always found over the course of my career that when things are quiet, it's important to pull the screen back and look at a bigger time frame to make sure that we keep things in perspective. And as you know, I like to go through some long-term charts, and so I'm going to do that again this week as usual, just to see what's changed, what we're doing in positioning. We're into earnings period. Earnings period is always interesting because one of the biggest buyers in the market, corporates, are out of the market for buybacks. So that takes out some support for stocks. There's always risk that we see things bounce around. But frankly, things are going okay. So we're now just about 13 years into a structural bull market that started in 2013. Market's up about 290% over the period. Comparing it to the bull market of the 80s and 90s, it's still reasonably anemic and relatively short-lived. This could go on another 5 years with interruptions. But when we look at the more near-term picture, market's very close to highs. It's up about 1.5% so far in the month of July. Month of July, first part tends to be strong. We've talked about the fact that when you came into the third quarter with a decent head of steam and stocks performing well and breadth reasonable, it tends to be the third quarter is pretty good. So far, first part of the month has been decent. Market is handling earnings as they're coming in. We're still very early stages in the earnings reports. Some good, some bad. But without the support of corporations buying back their shares, market's hanging in pretty well. When we look at the S&P, boy, what a rally off the lows in April. We came right down and touched the trend line that had been in place since the cyclical low in October of 22. And the market's been working its way higher since. So we did make new highs in the S&P. That's quite positive. Now, under the surface, there are haves and have-nots, as there always are. The percent of stocks trading above their 50-day moving average backed off a little over the course of the last 60 days. We moved from about 80% of stocks trading above their 50-day to 63%. Market's basically been working its way sideways. It's in a decent spot. When we look at the Qs, same thing. NASDAQ 100, growth led, went down 25% into April, and here we are basically back at highs. But it's a mixed picture. There are some areas of tech that are behaving better. The momentum is waning just a little bit, so we're watching that. Coming into August, as we get there, we want to watch for any signs of weakness. Equal weight S&P, when we take all the 500 components in the S&P 500 and give them an equal weight, it has moved nicely off those lows in April, but has not made yet a new high. And actually, when we go down market cap to smaller companies, the Russell 2000 has been unable to get back close to the highs. So it's been a fairly concentrated rally. Important to be in the right spots. We talked last time about the fact that about 48% of companies in the US stock market are performing constructively in higher highs and higher lows. So there's haves and have-nots. When we look outside the US, we continue to see strength. So this is the developed world ex-US ETF, so developed world stocks without including US equities. And we see that much like US stocks did in 2013, after a long period of not making highs, going all the way back to 2008, month by month, global stocks are marching higher. And that's a change. That's an important change. Over the last 18 months or 2 years, we've been building in a larger global component in our client portfolios, because when you start making new highs, tends to mean you're in a new bull market, and it'll go on quite a while. So that's the Euro Stocks 50, month by month marching higher. Germany is a good example. We could put up Spain, we could put up Italy, we could put up Switzerland. When we move to the Southeast Asia, India performing reasonably well up over the last 4 months. We did consolidate this big run up we had into the middle of 2024, coming into 2025, but now marking its way higher again. The Nikkei 225, after 33 years of going nowhere, broke out and consolidated for many months, which we talked about, and now breaking out to the upside on favorable price action. Asia is performing well. This is an ETF, the Asia 50 large cap Asian companies, like relative strength over the course of the year versus the S&P rising smartly. We go to Latin America, countries like Chile and Peru are benefiting from some of the strength in commodity prices. That's the Peru ETF. That should read EPU, I just realized, not EPI. And when we look at the Vanguard All World ex-US ETF. Now, I guess, it's possible we're going to get bored of looking at these charts because they're early days and they are monthly bars and they are very constructive. So different than sort of the equal weight S&P, which hasn't been able to make a new high, or the Russell 2000, which has not made a new high. Virtually all of the major markets are breaking out to decade-long highs. And I think that is telling. It tells us that money is spreading across the equity asset class, but to other places, maybe based on valuation, maybe based on currency shift. But money is in motion. This is an emerging markets ETF that is an ESG-based ETF. Probably pretty important when we're looking at emerging markets to make sure that they are doing things the right way in their businesses, but sharply making new highs. And there's the TSX, and funny enough, it's more closely correlated to global markets than U.S. stock markets. It's one of the best performing markets in the world this year. So for us here in Canada, those are some of the opportunity sets, and we're trying to make sure that despite the fact there's some world-beating companies in the US, there's other things to do and maybe at better valuations. When we do that comparison of the MSCI All World ex-US ETF, 1, 2, 3, 4, 5, 6, 7 months now off the lows, a new shift, global stocks outperforming. So I think that's important. TSX also outperforming the S&P. So it's really important that we watch for these structural changes. When you get into a new structural bull market, a couple things happen. First of all, companies will have been creating value while they were out of favor. Generally, stocks continue to grow their cash flow. When we look at what happened to U.S. stocks between 2000 and 2013, they failed to make a new high all through that period, but the cash flow for the average company in the U.S. quadrupled. And so by the time they were breaking out, valuation was really quite good. And I think it's similar. A lot of great companies in the global universe, not all companies, of course, but they're trading at much lower valuations than U.S. stocks, and probably the widest valuation gap we've seen in a long time. So 2 years ago, when we set out to build our global equity portfolio, our global equity fund, the idea was to buy high quality securities out of the global basket and split them roughly evenly, 40 companies that were strong relative performers or technically sound, momentum-oriented companies, and rebalance that regularly once per quarter over 12 months, turning the portfolio over once a year, and then have 40 companies that were value-oriented companies, low price out of favor companies that were also high quality, and to hold those over a course of 3 years. And things seem to be going pretty well. The All World Index based in Canadian dollars up 29% since December 29th of 23 when we launched. The global fund is up 40.81% over the period, and I think is very, very early days. So this is a component that most of our clients know. We're started with kind of like a 5% weight. We moved it to a 10% weight. We've added additional global holdings across the rest of the portfolio, and this is probably going to be moved to a 15% weight as we move forward through the year. So just an important change taking place, because what we see now is earnings are there, but we're starting to see multiple expansion. So we get earnings growth and the market starts to be prepared to pay a higher multiple of those earnings. That's where you get that excess return. And we think this is early days. In the fixed income world, not much is changing. 30-year yields have been working their way higher since March of 2020. These are monthly bars again, stubbornly sticky high. And that tells us something about what's going on out there. Obviously, bond investors think there is risk, and they are asking for higher yield to put their money out for 10 years or 30 years. The way the countries are spending money with their fiscal policies, and loosening monetary policy, there is risk of inflation restarting, and we watch that. The bond market tells us that. If the bond market thought there was disinflation, bond prices would be rallying, and they just aren't. Now, it's interesting if we look at the last number of waves of inflation, and I showed this a few months ago and we updated it this week. After an initial wave of inflation, and this one we were experienced in the US over the last couple of years, you got a moderation. And then after some number of months of moderation, you got a second wave. And we think this is going to be really important to watch, because, we've been watching commodity prices, for instance, and commodity prices are moving higher. Since central banks started to loosen again, we started a second wave higher in commodity prices. And commodity prices tend to lead inflation. We don't yet know what the impact is going to be of tariffs, or frankly, what the tariffs are going to be. But I think it's safe to say that historical cycles would say it's likely we will get a pickup in inflation again. So the question is the market telling us that? When I look at gold, it would say that people are hedging themselves against future inflation or the debasement of their purchasing power through, frivolous spending by governments. So gold has consolidated over about 12 weeks and is very close to breaking out to a new high. And that would be consistent with previous cycles. You see this consolidation we saw in the summer last year. And so it looks as though that's getting ready to go. And this is one of the best performing assets year to date. From a seasonality perspective, July and August over the last 15 years have tended to be positive months. And that's certainly happening. We're seeing the Chinese continue to add gold reserves, as most major banks are, central banks are around the world. And similar to previous cycles, the second wave should be led by silver. And silver has really started to move higher. Just in the last couple of months, we've moved from $28 to $39 an ounce. And my guess is, again, that's very, very early stages. Copper, 2 weeks ago, broke out. Let's see if I can put that back on the screen. Up about 12.7% since it did. But unlikely that this is the end. This is more likely the beginning. Now the last bull market happened after 2001. Tech stocks rolled over, inflation picked up, old economy companies did a little better, and commodities had about a 10-year run. And so copper was up 550% in that period. When we compare commodities to bonds, commodities are clearly outperforming, and that tells us people are leaning more to an inflationary asset than an asset that you would own in disinflation. Now, it's early days. So in the gold market, central banks are buyers. The price is moving higher. But look at what's happening in the ETF holdings. Private investors really have not caught on to this. And so we think we're very early. And then frankly, while the price of gold has been going higher and earnings are going higher and cash flow is going higher for the companies, price really has not responded to the same degree. So we'll talk about it. So gold versus the aggregate bond index is really outperforming. We are using gold across our portfolios as a safety net instead of bonds. They're less volatile than the bond market for the first time in 46 or 47 years. And we think the most important thing the market is telling us is that the risk that we have to hedge against is inflation. So stocks are outperforming bonds. That tends to happen when, in a more inflationary environment, you want companies that can raise price tomorrow when their costs go up today. A rising stream of income and a rising stream of dividends is attractive when there's a rising cost of living. Fixed income, not so attractive. Even commodities relative to the stock market now for the last 11 months have been outperforming. And my guess is sometime over the next little while, we will get a second breakout like the one we had in 2022 when rates were early on in their rate move higher. And that's likely to continue. The bond bear market relative to the stock market went on a long time leading up to this point, and it's still pretty early days. So if you were to stack asset classes up based on their relative performance, the best performing asset class over the last few months is commodities, led by precious metals. International equities, led by Europe, but other markets as well. Domestic equities, which of course we all have lots of exposure to. Cash, currencies, and then fixed income being the worst asset. So you can understand why we continue to have a very low exposure to fixed income, other than where we have to have fixed income and balance mandates. So what is driving some of this stuff? We think currency continues to be a big driver. US dollar, was rallying sharply for close to a decade versus the basket of world currencies. And in 2022, rolled over. And these, you can see, we have been moving steadily lower. So we're trading basically around the lowest levels we've been at going back, to 2022. And as the US dollar has been weakening, other currencies are strengthening. So you can see here from 2010 through 2025, US dollar was in an uptrend. And it has had a tendency, when it starts to back off for a while. And that means that people who borrowed money in their home currencies, bought US dollars to buy US stocks, might now be seeing their currency strengthening, like the euro is strengthening, like the Canadian dollar is strengthening, like the pound is strengthening, like the Japanese yen is strengthening. So you got stronger currency, you got stronger local markets. Maybe you take some money home and put it into your local market, especially given the fact that the multiples are lower than US stocks. Now, it also has to do with the sector makeups of those local markets. Are they attractive? And in many cases, some of the leading sectors are big parts of the global markets. So even global sovereign government bonds versus US Treasury bonds are outperforming. So that may take some incentive away for global investors to have so many dollars packed away in US dollars, so much currency packed away in US dollars. So that, combined with valuation for US stocks much, much higher than global stocks, is helping some of that money to find their way into other things. And of course, we like to own the things that other people are going to want to own. And so this is why we've sort of hedged some of our risks by having more global stock exposure and more gold exposure, and frankly, Bitcoin exposure. Bitcoin is an alternative to the US dollar. We think about the idea for US investors, but global investors, like to have some currency security in the event that there's capital controls. And Bitcoin, going back over the last 12 years, has had a series of bull markets and consolidation, bull market consolidation, bull market consolidation. It's currently in sort of one of those bull phases. So Bitcoin is today trading closer to $120,000. That's up sharply, and we like to have a little bit of exposure. So we built some of the Bitcoin ETF into most separately managed accounts, and we hold it in our macro portfolio. So we don't have to be everywhere. We want to find things that are leading, things that are being revalued. We want to watch for change, new leadership as it emerges, and old leadership as it wanes, so that we can make sure that the portfolio stay relevant. In the event that things aren't going well at all, we're very happy to have cash. But we want to focus on the things that, from a top-down perspective, the neighborhoods that are seeing expanding breadth, where over time, more and more securities are performing well. And I like to revisit that every week, and then we like to find securities within those groups that meet our business tests, that are high quality, that are technically sound, that are, as we call it, good getting better. And we can find those securities, and they match up in groups that are constructive in the market. Well, that's where our portfolio should live. Now, when breadth starts to weaken is when we start to get cautious, which is why I'm always talking about what we're seeing by way of breadth trends. And when that happens, we raise some cash and tighten up the stop losses that we have. So as we sit right now, the big picture continues to be very bullish. The percent of stocks in the US in uptrends has been expanding, still less than 50%. This can go as high as 70 or 75% late in a bull market. More stocks are performing well in global markets and in Canada. We are in summer, and some of the short-term indicators, as I mentioned earlier, have weakened a little bit. The percent of stocks trading above their 50-day moving average is a little weaker. Some stocks with momentum have given some back, as we're seeing some sideways consolidation. So we're monitoring this part, but in general, the big indicator continues to be positive. So let's look at the sector leadership. First of all, financials just continue to perform well. And over the last 2 years, we've talked about the fact that when this gets going, it goes for a while, and so we did get positioned early in things like Fairfax Financial and the investment banks. The broker-dealer ETF has had nicely rising relative strength going back to May of last year, and even through the correction, held up better than the market. We talked about Santander as being a holding that we quite like as on the global markets, because frankly, the Eurozone financials have only just started to move higher over the last 5 months. This chart, if you didn't make a new high since 2008. Now, within the financials, there is some change. The relative price strength of insurance companies has been weakening. And so you will see over the weeks, we have been reducing our insurance exposure. Berkshire, sort of the granddaddy of them all, has pulled back from $542 to $478. You can see the relative strength waning. Now only better than 30% of stocks in the S&P over the last year. Our biggest position, Fairfax, has just continued to be a champ. And so we are hesitant to make any changes here. Relative strength has been very, very strong, and we're really pleased. So same business, a little bit more nimble, and certainly they're doing a great job with their investment portfolio. Industrials continue to be leadership. Relative strength is strong. No major change there. The aerospace stocks were off a little today, but relative strength is great, better than 90% of companies in the S&P for the group. And that includes the aerospace and defense companies, and it includes the companies building equipment for the power grid. And that's something that we've talked about over the last while. That continues to be very strong as well. Materials really have started to lift. And so this is becoming a bigger component in the portfolios. The gold producers index, after consolidating over the last several weeks, is very close to breaking out to a new high. And I want to just talk about some of the fundamental reasons why they might happen. Now, we don't own Barrick. We've got others that we think are stronger, but this is a great graphic that's representative from our friends at Crescat. And this just shows the growth in earnings and cash flow per share versus what's been happening in the share price while the group was out of favor. This is why you can have an acceleration in the producers' share prices when things start to come into favor. The valuation gap is really substantial. So we've been enjoying a great run higher in Agnico Eagle mines. Agnico Eagle, I think, is really attractive for a bunch of reasons. They got 11 different mines, 3.4 million ounces of production. They've got a very low cash cost. They got 41 years of dividend payments and buying back shares. And even during a bear market for precious metals, outperformed the S&P, the gold index, and gold since 2005. Look at the last bull market. Again, US dollar was weakening through this period. Commodity prices were rallying. Agnico was growing. It was up 1,860% between 1999 and 2008. So this is a great start, but we think that there is room to move. And it's a dividend growth stock. We think it's quite attractive. Kinross today broke out to new highs after consolidating since early April. Wheaton Precious Metals broke out to new highs. It's one of the reasons that they say don't ever short a quiet market. When things are sort of meandering sideways, that's typical for a stock consolidating after a nice run. And when you start making new highs again, it marks the beginning of another run. So we think that's pretty attractive. Copper, we talked about the last couple of weeks, broke out of its range. So the copper producers are performing well. We added exposure there. Thought this was interesting. This is the first month where the diversified metals and miners ETF made a new high since 2011. Now this includes base metals, gold and silver producers, and it also includes steel companies and iron ore companies. So this is a broad-based indication of what you could expect. And this is still quite early days. Outside of the groups we've talked about, uranium, has been really very strong over the last few weeks. Cameco, nice breakout there. And again, representative in bull market, what can happen. 3 months sharply higher in early days there. Moving away from basic materials, communications companies basically have been treading water on a relative basis versus the market. Meta, Netflix, and Google sort of leading in this group. They did make new highs. Energy has been an interesting story. So I look at the Canadian energy producers partly because the big Canadian producers tend to have very long life assets. In the US, price is really important because not many of the producers have a lot of long-term assets. They have to keep on drilling to keep on producing. When we look at Imperial as an example in Canada, why is it outperforming? Well, they got 25 years worth of reserves in the ground that they can produce. They have the third lowest cost of production of all of the majors. And so they can make money at much lower oil prices. They're returning capital to shareholders. It's been a great dividend growth stock. And, in a bull market, it really can have a good go. This is the last bull market. So we focused a little bit more in and around the oil companies, Imperial and CNQ. In the last couple of weeks, we did reduce exposure to natural gas, moving away from ARC Resources and Expand Energy. Both you can see broke from a relative basis and broke from a price perspective. So not everything is roses, but that can happen in summer, and that was always a risk. On the technology front, relative strength is been pretty good. The XLK, made up of all the biggest growth technology companies, has had a nice move off the lows. It's not everything. It's largely the cash flow generating dividend growth stocks that have been leading. They have outperformed the tech index. And on the other side, we're still just a little cautious on the semis. Now, within the group, NVIDIA is clearly leading. But we're watching this relative price performance. We're watching the fact it has not yet gone back and made a new high. There's lots of companies yet to report. And the percent of stocks in uptrends, or the bullish percent for the semiconductor group, has backed off just a little from close to 80% of companies in uptrends to 68%. So, we're sticking with the strength. NVIDIA has been the strength. Broadcom has been the strength. But we're watching the group for signs that they could start backing up. Consumer discretionary, a little bit better on the price chart, but relative strength is still pretty sloppy. We'll watch and see if there's any turn here. Not a lot standing out that's super positive. Consumer staples, defensive, relative strength very poor. Utilities, relative strength remaining poor. Healthcare, relative strength remaining poor. And REITs. So these are all highly dependent on the bond market. They're all defensive sectors you'd want to own if you think that there's a risk to the economy. So even though we don't own them, there's a message here, and the message is that money is finding its way into more economically sensitive securities. The cyclical stocks in the market are leading, and that's been going on for a little while. So new highs for cyclicals versus defensives. I think that's positive. When we look at breadth, the sectors on the far right side here are largely economically sensitive groups, even though semiconductors breadth has started to back off a little. So what does it mean in the portfolios? Well, sounds a little boring, but financials continues to be our biggest weight. Industrial second biggest weight. Technology's moved up a little because they have been performing well, and materials has moved higher. Energy we've reduced by about 6% over the last 2 weeks. And that's largely the natural gas exposure. Communications have been pretty static. Consumer discretionary, pretty static. Defensive sectors really have been small pieces of the portfolio. So we're pretty fully invested. We're pretty hedged to inflation. And just to put a point on that, our global macro portfolio, which we use as a hedging tool, it can be in any kind of ETF and any kind of asset class where we think we want to overweight exposure. By far, our biggest exposure here is precious metals. We use this pool as a 5 to 10% weight in portfolios. So in the overall scheme of things, even though it looks like a big weight, it's a relatively small weight for portfolios. But when we look at it, precious metals, global equities, industrials, a little bit of technology, materials and financials, some Bitcoin, emerging markets. And then when we look at what we are invested against or short, we're short the US dollar, we're short US government debt, and short defensive sectors. And this is working out pretty well so far in the year. It's up about 10.5%, up a little bit more today. Versus the equally weighted S&P in Canadian dollars at about 0.5%, or the S&P up about 2.6. So risks, we always worried about credit risk, but the market clearly doesn't agree with us. The excess return bond investors are demanding to own a corporate bond versus a government bond has been contracting. That tells you that bond investors are actually more comfortable buying corporate bonds like a Microsoft bond than a sovereign bond. Volatility is solidly within the range of what would be typical during a bull market. And we're darn close to highs. So, we are in the reporting season. And during the reporting season, in the blackout period, companies don't buy back their shares. The peak of the buyback period is July 20th. Sorry, the blackout period. That means as we go forward, corporations come back into the market to participate. And so we should see more buyers step back into the market. If things get more sloppy or we see some changes in the breadth models, we can certainly get more defensive. But that being said, things look pretty decent. And we're pretty happy with the way the portfolios are set out. Not everything in the market looks great. I think you really have to pick your spots. The opportunity for us as active managers, I think, almost has never been better. If you think about materials being at 3% of the S&P, but performing so darn well, there's opportunity to target some groups that are not big within the index, and global stocks can add a lot. So with that, let's see if there's any questions. Excuse me. I have one question today. Do you still have the same conviction on GE Vernova after the recent run up? Look, we think that the market is telegraphing that there is going to be a lot of spending on the power grid. In the US, in Canada, I was speaking to a senior executive at Ontario Hydro last week. You know, they're looking at tripling their output over the next number of years. So everywhere in the world, we're going to have new nuclear. We're going to have more peaker plants that are natural gas driven. And GE Vernova is likely to be selling turbines to a lot of them. So look, GE Vernova is going to have pullbacks for sure. When we look at the sector, the stocks that supply into the grid, they're performing well. The nuclear stocks are performing well. And in the industrials around the space, I think look pretty good. So can always pull back. It is a momentum stock, so pick your stop. But we own it and are very happy shareholders. See if there's any more. I don't see any more open questions. I'm shocked. Okay, well, look, it's summer. I hope everybody's getting outside and enjoying it. Here in Toronto, we know pretty soon the cold weather will come back and it's back to the penitentiary. So enjoy your summer, and we'll look forward to seeing you again next week. Take care, folks.